Tariffs, the stock market, mortgage rates. Oh my God, what's going on? Mortgage rates today are at an average of 6.85, right? As of right now, let me give you the report. Mortgage rates 6.85. Last Friday, they were 6.55 when I talked to you all about how the Treasury had gone down. As of this moment, stock market's up 78 points. 10 minutes ago, it was down. Okay, Treasury yields. Let me take a look at that. The 10-year Treasury. Hang on. 10-year Treasury is at 4.387. Last week when I had done that video, when everything started, it was down to like 3.8 or 3.6. Let me take a quick look here. So obviously there's a lot of volatility going on, okay? And I want to show you some graphs that talk about that and talk about some things that have happened in the past. Let's take a look back to 5 years ago when COVID hit and what exactly happened at that time. Remember, I remembered this yesterday and I wanted to show all of you. I asked to pull the graphs. There was a lot of volatility before rates came down in a sustainable manner. You can see right here in the graphs, 30-year fixed rate mortgage, okay, right from Mortgage Daily News. Rates were in the high threes. Then we got to sort of middle of the winter 2020. The talk of COVID increased through that February. Rates were coming down initially, just like what happened last Friday. Then all of a sudden things got to the point that it was like the bottom fell out and investors, not only they didn't want to be in the stock market, normally investors put their money in the stock market, and then when stock market goes down, they pull their money out, they put it into bonds, they put it into treasuries, and what does that do? Lowers mortgage rates. That's exactly what happened last Friday. But since last Friday, it's like it hit the fan all over the place. The weekend happened, the overseas markets, and investors said, I'm pulling out. I'm not going to the stock market. I'm not buying treasuries, bonds, none of that. So what happened? Now rates went back up. Same exact thing happened in the first about 6 weeks of when COVID officially hit. A lot of volatility, but by the end, by the time we got nearly to summer, rates were 3%, and we all know what happened after that. Rates were 3, high 2s for about a year and a half. That is the kind of thing that's going to play out here in time. And even if you look at the stock market, back at that time, you can see the same thing when the market started going down. And if we could overlay these graphs, you'd see it followed a similar pattern. Market went down, then it leveled and came back up again, back into the, well, call it mid or high 20,000. So what does this mean for right now? What it means for right now is we're going to deal with volatility for at least the next month. I actually think it may be longer. At that time, the Fed stepped in. There were a number of things that happened with the government where they stepped in and said, we need to steady the ship. I'm not really thinking that's going to happen as much on this. However, at some point, the Fed is going to have to lower the short-term rates. When will they do that? Let's see what happens tomorrow. Tomorrow, there's a consumer price index report coming out. CPI comes out every month. If that comes out higher than expectations, the Fed's going to have to hold their ground longer. If it comes in lower, that would give them reason to lower rates sooner. Many people think that the Fed will lower short-term rates in late May or June. If that comes in light, maybe they'll do it sooner because of the pressure. It's pretty clear to me that this administration is obviously taking a much more aggressive stance on a number of things, but they're also going after inflation much harder. Now, credit to I'm not trying to be political here, Biden's administration tried to lower inflation as well and did have some impact on doing that over the last year. Trump's administration came in, they want to be more aggressive. I look today, oil prices are down, lots of things are down. And some of that's good because it relates directly to mortgage rates. So I'm glad to see them aggressively tackling lowering inflation. I've said to many of you in many videos for the last, coming up on 3 years, we will not, I've said it this way, we will not see lower mortgage rates in a sustainable manner until they get inflation down. Well, Trump's administration knows that they're going to have to get very aggressive about that happening. Also, I don't know if you all realize this. The government has $9 trillion worth of debt that they have to refinance this year. 30 trillion, 28 trillion over the next 4 years, but 9 of it this year. So they are looking ahead over the next 6 months saying, oh my God, we've got to get rates down at any cost. Clearly, they're using tariffs as the tool to do that because they know that it'll disrupt markets. Now, I've said it before, I'll say it again. Nothing will lower rates in a more sustainable manner than an actual recession. It's like going through a sickness to then get healthy again. I've said that all along. Trump's team is clearly trying to slow things way down, but not totally hit the bottom, and they call it a soft landing. Can they pull it off? I'm not convinced they can pull it off. Biden's team was trying to do the same thing, but it was happening very, very slowly. So what's right? I don't know. I'll let you all debate that. But I am here to tell you that I'm very confident that when we get to the end of this disruption, 6-8 weeks, we'll start to see mortgage interest rates come down. Will it be that soon? Maybe not. The mortgage rates might hold until we get into fall or the end of the year. I think it might take a little longer than it did last time during COVID. But I do feel very strongly that in the end, our system, our whole economic system, will be better off because of this disruption. Hopefully I'm right. The question is how long. We'll see. Bottom line, over the next 4 to 6 weeks, there's going to be volatility. You realtors who are watching, which is most of my audience, you are going to have buyers that get nervous about buying, sellers that get nervous about selling and buying something else. And you might want to remind those buyers that pulled out of buying 5 years ago right now, how did they make out? They paid more when they got back in, and some didn't get back in, and home prices are 40 to 50% higher than they were then. Right? So we shall see. Stay tuned in to Crush It in Real Estate and my Instagram, where I do shorter, more brief updates along the way. Thank you all.